Picture this. It's April 2026. The brand new Income Tax Act 2025 has just kicked in, and your phone rings. It's a key corporate client, and they want to know exactly how to restructure their employees' salary packages to maximize retirement savings under the new laws. Are you ready with the answer? Well, welcome to today's Explainer. We are breaking down Section 124 of the Income Tax Act 2025. This is the absolutely crucial section that now governs deductions for employer and assessee contributions to central government pension schemes. Read right alongside Schedule XV. So whether you're a practicing CA, a tax student, or a business owner, getting a firm grip on this transition from the old 1961 Act isn't just helpful, it's absolutely essential. Let's dive in.
Here's our game plan for today's agenda. We'll cover 1. An introduction to Section 124. 2. A breakdown of deduction limits. 3. A practical taxation example. 4. Compliance and necessary forms. 5. Common mistakes and misunderstandings. And 6. Summary and key takeaways. We're going to cover the whole shebang, from the legal foundation to the exact new forms you need to file.
Starting off with Section 1, Introduction to Section 124. Let's establish exactly what this new provision aims to do under the modernized tax code. So you might be wondering, how exactly do we optimize retirement savings during this transition? The core objective of Section 124 is actually the same as the old law. It's there to encourage individuals to save for retirement through notified schemes like the NPS. But the mechanics, the references, and the terminology, they've gotten a massive overhaul. That's right, Section 124 officially succeeds the old familiar Section 80 CCD of the 1961 Act. But here is the real game changer. We are entirely shifting away from the confusing dual terminology of previous year and assessment year. The 2025 Act introduces the unified tax year concept. As clarified by the transition FAQs, the tax year aligns perfectly with the financial year. So for income earned from April 1, 2026 to March 31, 2027, you literally just call it tax year 2026-27. Honestly, no more mental gymnastics trying to calculate the corresponding assessment year. It's so much cleaner.
Moving right along to Section 2, the breakdown of deduction limits. This is where the numbers get really interesting because the statutory limits are bifurcated.
But before we look at percentages, we need to establish our baseline. What exactly counts as salary? Under Section 194.13b of the new Act, salary is strictly defined as basic salary plus dearness allowance. And remember that DA is only included if the terms of employment specifically provide for it. It completely excludes all other allowances and perquisites. If you accidentally calculate your 10 or 14% limit on a gross salary that includes bonuses, your computation is going to be legally invalid.
Okay, let's look at the actual tiers of deductions. Under Section 124(1)(a), if the employer is the central or state government, the deduction limit is a solid 14% of the employee's salary. Now, for other employers, meaning the private sector, Section 124(1)(b) sets the base limit at 10%. But, and this is a massive but, Section 124(2) states that if the assessee's income is taxed under Section 202(1), which is the new default tax regime, that 10% private employer limit gets bumped up to 14%.
When you see it laid out like this, the impact is obvious. If a private sector employee sticks to the old optional tax regime, their employer's contribution is capped at 10%. But the moment they shift to the new default regime under Section 202, boom, they unlock that higher 14% threshold. This is an absolutely crucial planning tool for HR departments and tax consultants when you're structuring compensation packages. All right, let's head into Section 3, a practical taxation example. Theory is great, but let's actually apply this to a client's numbers.
Let's walk through this step by step. Imagine an employee at a private IT firm who is under the new default tax regime, Section 202. Step 1, calculate their eligible salary. Let's say their basic pay plus DA comes to exactly 10 lakh rupees for the tax year. Step 2, since they are under the default regime, we compute the employer contribution limit at that higher 14%. So that's 1,40,000 rupees. Step 3, the employee also voluntarily invests in the NPS. And Step 4, we add it all up to find their total eligible deduction. And speaking of that voluntary investment, I really want to emphasize this specific figure, 50,000 rupees. This is the magic number. It's the additional, exclusive deduction limit available to the assessee under Section 124(3). This is purely for the employee's own contribution, and it's over and above the employer's contribution we just calculated.
So, in our IT firm example, the taxpayer gets the $140,000 employer deduction, plus they can claim up to this $50,000 for their own deposits. It makes it an incredibly tax-efficient savings vehicle.
Let's move to Section 4, Compliance and Necessary Forms. Because knowing the law is just half the battle. Getting the paperwork right is what actually keeps your clients compliant.
So, here are the operational updates you need to roll out immediately under the Income Tax Rules 2026. First up, you know the old Form 12BB used for investment declarations? It's gone. Employees must now submit Form No. 124. Employers will then adjust the TDS on salary based on Section 392(5)B of the 2025 Act. It is absolutely critical that accountants and business owners update their payroll software to reference Section 124 instead of ADCCD, and make sure all documentation uses the term tax year.
On to Section 5, Common Mistakes and Misunderstandings. Transition periods are notorious for legacy habits tripping people up, so let's look at what to avoid. The biggest mistake we are anticipating is double dipping. Under the new Act, Section 123 replaces the old ADC limit of 1.5 lakhs. Now, pay attention to Section 124.10 because it creates a strict limitation. If you claim a deduction for a deposit under Section 124.3, that extra 50,000 rupees we talked about, you absolutely cannot claim a deduction for that exact same amount under Section 123 for that tax year. There is a strict separation. You can't count the same money twice to inflate your deductions. It just won't fly.
Finally, Section 6, Summary and Key Takeaways. Let's bring all these legal and procedural points together.
Here is your rapid-fire recap. 1. Section 124 is your new home for pension deductions, waving goodbye to ADCCD. 2. Employer contribution limits are 14% for government and anyone under the default regime of Section 202 and 10% for other private employees. 3. Assessees get that exclusive extra 50,000 limit under Section 124.3. 4. Watch out for Section 124.10. No double dipping with Section 113. And 5. Transition your TDS compliance over to the new Form 124. So I'll leave you with this to think about. How will you audit and update your clients' payroll systems to ensure zero compliance friction when April 1, 2026 rolls around?
Thank you for watching. Please like, subscribe, and share to stay updated on the Income Tax Act 2025. This explainer is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational explainer.